What does diversified mean? In particular, we are talking financial diversification.
Hi, welcome to Financially Intact. Making money is easy, keeping it is the hard part. The channel dedicated to helping you keep your money in your pocket.
According to Investopedia, diversification is defined as a risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or risk. I don't think many financial advisors get the actual concept. The actual concept being what it says right here: a diversified portfolio contains a mix of distinct asset types. I've seen client statements, and their advisors many times have them in 12 to 20 different mutual funds. And when I ask the people why they're in so many different mutual funds, they say it's because their advisor said, well, we need to keep you diversified. Stocks are but one asset class. Therefore, mutual funds are but one asset class. That is not true diversification. That's just being scattered all over the place. As you will see here, I teach that there are 4 actual different asset classes. And I would agree with someone if they wanted to argue with me and say there are 5, but we'll cover that in just a few minutes. But before we get to the 4 major asset classes, let's explore why it's important to be diversified in the first place into those 4 classes. Every asset class has 3 common characteristics. And as the old saying goes, you have to give up something to get something. But what are those 3 common characteristics that they all have? First one is risk, the second one is liquidity, and the third one is rate of return. Like I said, to get more of one of those 3, you have to give up some of one of the other 2. I teach a class that's called the cash class, C-A-S-H. What that stands for is the C, of course, these are the 4 asset classes. C stands for cash, A stands for annuities, S stands for the stocks, and H stands for housing or the real estate market. These are your 4 main asset categories. So now let's take a look at each one of these and see what you get, what you have to give up as far as the characteristics are concerned, and what the products look like. So the first one being cash, of course. So what we have with cash type products is we have very low risk or virtually no risk. We have good liquidity in most cases, but we also have very low returns. These are basically your bank products. So your checking accounts, your savings accounts, your money markets accounts, and your CDs. And even in here, you would notice that if you decide to go into CDs, you have less liquidity, but of course you would then get a higher return. So like I said, anytime you're going to get something, you have to give up something, and that's the way the different classifications work. So the second one, of course, was A, and that stood for annuities. So with annuities, we have low risk again. They're very, very safe, almost 100% safe. But we do have lower liquidity in this case. You can't just take your money out like you can out of a savings account. And we still have low, but we have higher returns than you get in the banks. Usually 2 to 3 times higher, sometimes as much as 10 times higher. So it depends. The kinds of products that you get, so these are insurance products, of course, annuities. The kind of products you're looking at is fixed annuities, also called MYGAs, which stands for multi-year guaranteed annuities. If you haven't already seen that video, you might want to go check that one out. We did a video just on the MYGAs just here recently. You also have the fixed indexed annuities. Now these are, why they're called fixed indexed, is they are tied to the performance of the market, but they are not invested inside of the market. So they're fixed. You cannot lose money on these, but you can make a little bit more than you would with either a MYGA or your CDs. So you end up getting about 40% of what the market does, somewhere in that neighborhood. And then you have the immediate annuities. That's what most pension plans are made out of. You give money to an insurance company gives you a monthly check back for the rest of your life. So like I said, with these you have very, very low risk. They're 100% guaranteed, but you do have low liquidity, but you have higher returns. So once again, what did we trade off here? We traded off some of our liquidity for somewhat higher returns. The third asset classification is the stocks. You have your stock market. Now with the stock market, we have much higher risk, of course. We have good liquidity. You can usually get your money out in just a day or two, and we have much higher returns when the market is up. Of course, now because of the high risk, we also have we stand the risk of losing money. And so here, the liquidity stayed the same, but in order to get the higher returns, we had to give up the low risk. So we had to accept higher risk. So like I said, whenever we get more of one of the characteristics, we have to give up some of one of the other characteristics or some of both of the other characteristics. So that's your stocks. Now inside your stocks, the type of products that we're talking in the stock market, of course, are individual stocks, ETFs, electronically traded funds, and then of course our mutual funds. So those are your different products within the stock asset classification. And then the fourth classification we have is housing or real estate. Now with housing and real estate, of course, we have very low risk. Again, very seldom does the real estate market go down. It does at times, but very seldom does that happen. But we have very low liquidity. Now you can't just go and say, gee, I want to take out $5,000 out of my home. You can with a home equity loan, but that's not going to happen in a matter of minutes. It's going to take several days, if not several weeks, and you have to go through a whole lot of paper. They're not very liquid. On the other hand, your returns are fairly average compared to a long-term CD, or you're talking normally in the 3 to 5% range on return on assets. Now real estate property could be a little bit higher than that, but on the average, because of all the costs also involved with real estate property, till that property is paid off, you're usually not going to get much more of a return than that 3 to 5%. So what kind of products do we have? Well, of course, we have real property, such as the home that you are buying and live in, or rental properties. Now, if you don't actually want to own the properties, you just want to participate in rental properties, you can buy, it sells like a stock, but they're called REITs, R-E-I-T, and that stands for Real Estate Investment Trust. And we'll do a whole separate video just on those here in the near future. You also have available to you a thing that's called limited partnerships, and we'll talk about that sometime in the future. So those are the major classifications of assets. But now the big question, of course, is how much or what percentage of your money should you be putting into each of those asset classifications? And of course, the answer is balance, and there is no one set answer. The answer will be different for each person. So I can't tell you exactly what your answer would be. There is no right universal answer, but there is a right answer for each person. And how do you come to that answer? Well, we go all the way back to our first screen. We have risk, we have liquidity, and we have rate of return. You have to put these in the order that they are of importance to you and by how much. If you're very risk adverse, then you want to make sure you don't put a whole lot of money into stocks. If you want a whole lot of liquidity, then you want to deal either with stocks or with banks, once again depending on the risk. If you're satisfied with an average rate of return, you might want to be looking at annuities, which are very safe but offer you a better return, but they have a little bit less liquidity. As I stated in the beginning, I've always stated, and it will always be the same, if you want more of one of those three categories, you have to give up more of one of those three categories. So the other classification that some people might consider its own classification would be that of commodities, in particular like precious metals or oil. Because of the same characteristics, actually put those in the stock classification. They're kind of a subcategory of that. Now the other thing that when you're deciding how much money to put into each asset class, The other thing we need to remember is none of us want to lose money, but on the other hand, losing purchasing power is just as bad as losing money. It's another form of losing money. So that's why I said on that second to the last slide there that balance is important. We have to balance between the risk, the liquidity, and the rate of return so that we not only don't lose money, make money hopefully, but also so that we don't lose purchasing power. Hopefully that will get you started. Upcoming videos will explain different aspects of investing, such as the S&P 500, the S&P 400, bank products, REITs, real estate investment trusts. So stay tuned and make sure you hit the subscribe button and hit that little notification bell so we can tell you when the new videos come out. The next video is about small-time investing. Whether that be because you only have a few dollars to invest, or maybe you only want to invest a few dollars. Either way, I'll give you some practical ways to do just that. Talk to you real soon.